So let's talk about the next thing. The focus of the media is always on the last thing that occurred. Let's talk about the next thing. The last thing that occurred has been interest rates going up, inflation, the banking crisis, and they're still talking about that, and they're like, oh, things are coming down. So what is the next thing to occur? The next thing most likely to occur, let me show you the factors first, and then we'll talk about exactly what it is. So, right here, I'm going to pull it up just a little bit. Right here is the Fed, is the prime rate, okay? All commercial lending is either at a discount point to the prime rate or at prime rate. So the last house I bought was at 7.25%. Prime rate is at 8 right now. It was at 3.5. Okay, that is a 160% increase in the expense costs of having a commercial property. Now, if you combine that with the fact of work for homes devaluation of a lot of the real estate, which was for business properties for people to work from the office and those type of things, you get a really bad situation where this property's value is now dropped dramatically in value, and the cost to carry it has been way up. So at the point before and right now, you're looking at maybe a 3% carry rate for this property. So the person's just, they're paying $3 on every $100 of debt every year, so the property is renting for less, and they're just carrying it because they don't want to take the loss. They think maybe it'll come back, maybe they can convert it. But what's going to be coming pretty soon is that 160% increase in expenses, and here's how that works. They say that a lot of commercial debt, more than half, is at a fixed rate. And so you say, oh, that's great, that's a fixed rate. It's fixed for 15, 30 years, fixed to the term. No, that's not how it works. It's generally a 5-year fixed rate, and it's on a 20-year amortization, which means in the first 5 years, the rate is fixed. And then you still have maybe 90% of the debt there that then gets renewed at a new rate, which now is 160% higher than the original rate. And how much debt does it happen? Well, if you've been steadily increasing over time, you've got 20% of your debt that comes up every year. And so it's been, 8 months. So debt's coming up next year that's going to bump that up into the new rate. And so that is going to dramatically affect commercial properties. And that has not yet been priced into REITs that hold those type properties. And so if you look at a REIT and the REIT is down, let's say like the market, 20%, and it holds these properties that are no longer at the value that they're assessing on the REIT, when does the REIT take that loss? I mean, do they go out and say, oh, this property is valued at $10 million, but now it's only worth $5 million, let's take that loss on our books? No, that's not how it works. It works similar to the way the bank works, okay? So the way the bank worked that you saw, in effect, was they carry the losses as paper on the balance sheet until they actually sell that asset. And so in the case of Silicon Valley Bank, what happened was they had these losses because interest rates were going up and up and up on their both their mortgage-backed securities and their government bonds. And so they're just carrying that, right? Which is somewhat fine, except when they need the money. When they need the money, they have to actualize those losses. And so if you have a commercial property that's worth $5 million and it goes to $10 million, you don't claim a gain, okay? You might raise rents or things like that as the value goes up, but if you have a commercial property, $10 million, and it goes to $5 million, you also don't take the loss. But you may have to, over time, decrease those things. And so you have these commercial real estate holders where their real estate is far below the value of what is assessed from when they bought it. And they haven't taken those losses. So when will those losses come about? Well, they'll come about in two situations. The first situation is when, like I mentioned, they have to sell it because they need money and at that sale they have to actualize those losses. Okay. The second situation is when they come up for renewal. When they come up for renewal, the bank is going to look at those properties and they're going to say, can this property, which was worth 10, now is worth 5, collateralize a debt of $7 million? Well, the answer is no. Okay, so you can't collateralize $7 million loan on a $5 million property. Maybe the cash flow has dropped, and so those two things will mean that the bank will not want to renew that loan, and at that point they'll have to sell the property. So that may come up with, I'm going to say the first 20% of the portfolio will come up within the next 6 months, and the bank may say, well, we'll renew this loan, but you're going to have to put additional properties against that loan, or we're going to carry it based on your balance sheet profits. But after about 6 months, you're going to start getting into situations where the second portion of those loans come up, and the properties can't cover the rates and the interest and things that are there, and so then they're going to have a problem. They're going to have to sell properties to try to get that loan down in value, and they're either going to sell quickly properties whose value has not changed, or they'll sell the property that has the problem, or they'll default on the property. Now, when you're smaller, like I am, you have to personally guarantee the loan, so your entire livelihood is riding on a loan, and if the property can't cover it, then the business covers it. If the business can't cover it, then you cover it. But with a larger property, what can happen is, let's say it drops from 10 to 5 million in value, and then you go out to sell it, and it's not worth the amount that you owe on it, so you default on it. Well, that goes back to the bank, and then the bank would have to then try to sell that property, take the loss. That loss would then be transferred through the system to mortgage-backed securities or other things that are backing that loan, because the system is kind of interlinked. Now, I don't myself anticipate a lot of, we're going to say, collateral damage like in 2008, where you had banks, getting crushed by, mortgage-backed securities and those things. I don't think that's going to happen with people's loans, because most of those are fixed term till the end. And so the assessment right now for people getting new loans would be based on their current finances and things, which is accurate. But the situation I think that you can get into is where these commercial real estate companies take the hit, or certain lending institutions that focus on commercial real estate, take the hit. And some may have a large portion of their balance sheet in commercial real estate, in such as New York, or in cities that had lots of people going to work that aren't going to work anymore, and so those particular banks regionally could get hit in this situation. And I don't know if there's a $1 trillion loss across this system. I don't know how much of that loss is borne by the REIT or the owner of the property, and then you have the bank, and then you have the backing of the bank's lending. I don't know what those portions are, but that's what I think you'll see next. And interest rates don't have to go any higher. The 3.5% to 5% to 8% prime rate is plenty. 160% increase in those costs is plenty to cause this issue. It just has to stay this level, and I think personally that the interest rates will stay this level for a period of time until this starts to play out. And when this starts to play out, they'll definitely have to drop interest rates. And so I think you may see, at latest, maybe March to June next year, them dropping interest rates due to this issue, or fear of this issue. But I just want to take a minute to share that with you. I know most people aren't in commercial real estate. They don't see how things tie together end to end, and how this can affect. How does this affect you? Next year, interest rates will most likely be down. When you go to get a loan today, the interest rate will affect how much of a loan you qualify for. and the house prices will be adjusted some, but not a lot, maybe 10%. But if you have a high loan now that you have, I definitely wouldn't refinance it. I'd wait until maybe toward the end of next year, and then see where we're at that point, maybe refinance it. So you may buy a house now at the high loan if you can qualify, try to get a good price on the house, something that has to sell fast and can't sell it, maybe in the January, February time frame, and then just plan on 12 months out refinancing that mortgage. So don't pay your points down and things, but just carry it for 12, 18 months maybe, and then refinance it at that point and get the lower rate. But just letting you know my perspective on this stuff. I am in real estate and retail and investments and have a regular job also. So it kind of gives me a maybe 3 or 4 different perspectives on a situation. And hope it's valuable for you. And have a great day. Bye.